welcome everyone. Thanks for coming to our presentation today. Appreciate you taking time out of your schedules. This is our first inaugural presentation on any tax topics, so you guys are an elite company. You get part of our first tax seminar. So as maybe you already found out, there's some food, drinks over there. I think all of you signed in at the sign-in table. We provided some information for you in those folders, including the slide presentation. There's also a note page as well for you to take some notes if you'd like. Anybody have any questions before we get started or anything? No? So, really excited. So, well, as many of you already know, I think all of you in here knows pretty well, I'm Ryan Cook. I'm the CEO of Cook & Company. We're a CPA firm here in Clinton, Missouri. We won some awards and commit a lot of time to our community and giving back and educating not just our clients but the public in general to help keep a tax efficient process going. So I wanted to introduce a few of our team members we have with us today. So co-presenting with me here in a little bit will be Amber James. She's one of the CPAs in our office. We have Kelsey Knight. She's on the keyboard over there. She's also a CPA in our office. We have Brandy Lewis. She's our Director of Operations. And, of course, I've got my wife and kids back there in the back. And we also have 3 FBLA students with us today. So we like to support our local FBLA chapter. And they're going to nationals. I think there's, 16 of you that are going to nationals here this summer. And so in support of them, we asked them to record our presentation, and then we'll make a donation to their organization to help pay for their trip to nationals in return. So we have Nathan Griffey, Gage Cooper, and then my daughter Ashton Cook back there. So we'll go and get started on the presentation. We're going to try to keep this to 1 hour if possible. There's a lot of new things going on, so we'll try to cover the high level things, and we do ask, though, that any questions you have, just kind of jot those down and hold them till the end, and then we'll do a question and answer session at the end, and then you can also catch us one-on-one afterwards and ask us some questions as well. So, all right. So, Kelsey. In your slides, we'll have, there we go, it's in sleep mode, I think, sorry. Here's some contact information. You can obviously find us on our website. Has my email address and Amber's email address. We put ours on there since we're the ones presenting. Our phone number's on there too. You can also follow us on Facebook, Twitter, LinkedIn, and we also have a YouTube channel that you can follow us on and subscribe as well. So if you're into that stuff, please follow us. If not, we hope you get on there soon. All right. So we hear there's some tax simplification, right? We had a new tax act passed December of 2017 towards the end of the year. So while business taxes really kind of got more complicated, business taxes or individual taxes got a little simpler. So now you just simply have to put your Social Security number, put how much money you made, send that amount of money in, and then my favorite part is if you have any comments, you write them in this little bitty square down here. So apparently the government doesn't want any feedback along the way. So no, I wish it were that simple, but it is obviously not. And although the tax reform was supposed to make things a little simpler, it, like I said, alluded to earlier, it made things a little bit more complex. So we got, as if that wasn't enough humor for you, we got a little bit more accounting humor for you. So there's nothing like accounting humor. Some of you may or may not understand the first one, but if you decide to change your name to a symbol and you choose a double underline, so obviously accountants like the double underline, but some of you, there's an artist formerly known as Prince that you may or may not know. Some young people may not know. Most of you probably know who Prince was, but, or formerly known as Prince. But you might also be an accountant if you like to do, or if you deduct XLAX as a moving expense. So you have no idea that Gap is also a clothing store. And your idea of thrashing the hotel room is refusing to fill out the comment card. So that's about as crazy as we get in the accounting and tax world. So just a reminder, there's taxes can get political in some ways, but we're going to avoid any political discussions today, and we're not going to talk about some of the sunset provisions of the new tax law because they're projected to sunset 2 presidential cycles away. So we're going to kind of keep it to the facts and just kind of tell you some things that we think are important to you and your businesses. So I'm going to turn it over to Amber now. She's going to talk to you about accounting methods and depreciation.
Thank you. Okay, so like Ryan said, I'm Amber, so it's nice to see all you guys. I know I haven't met a lot of you, so I'm kind of one of the people that does like tax work behind the scenes, so which I'm fine with sometimes. But okay, so the first topic that I'm going to discuss is about accounting methods. So an accounting method is the way that you, like the rules that you follow to report your income and expenses. A lot of times we kind of help decide which sort of accounting method would be best for your business. So there are a few different types of accounting methods. So there's the cash method, which a lot of our clients use. It's the simplest, it's the easiest. There's quite a bit of wiggle room in the cash method because you're able to, you have to report your income when it's received, so you have a little bit of leeway then. And then you report your expenses when you pay them. So there's also quite a bit of leeway, which we'll discuss on the next slide. The other method is the accrual method. So a lot of the bigger businesses and companies are forced to use this method because it has a better matching technique. In this method, you are required to pick up your income when you earn it, and you can deduct your expenses when they are incurred. So there's not as much leeway in this method. And then the special methods, the long-term contract accounting, that would be for like a big construction company that is doing a job that lasts 2 years. So there's some specific methods that you have to do with that. There's like the completed contract and the percentage of completion method. And then there's also some hybrid methods. So, kind of like we were discussing, the cash method is obviously easier to do. So the IRS has set in this standard that if you have gross receipts of $25 million or more, and it's over an average of 3 years, then you are required to do the accrual method. If you're under that threshold, then you can do the cash method of accounting. It also helps with you don't have to report inventories and cost of goods sold, which is a little more complicated too. And then the 263A, that third bullet right there, that is UNICAP, which like none of our clients really have that. But it's just a really complicated, confusing topic that causes a lot of legwork and is super expensive to get calculated. So that's what that one is. And then again, it helps determine whether the completed contract method of accounting can be used rather than the percentage of completion and such like that. So the way the test is calculated is you look back to the 3 previous years. So for 2018, you would look to 15, 16, and 17, and you would add up all your gross receipts, which is going to be all of the income you've brought in. So that would be before any type of expenses, and then you would divide that number by 3 to see if you are under this threshold. And in the past, this number was $5 million. So a lot of somewhat smaller firms, were over this threshold and were being required to do the accrual method, which, again, like I said, is a little more complicated and more time-consuming, and there wasn't as much leeway with that. So this is a great thing that the IRS is doing to kind of up the threshold to the $25 million. Okay, so the first topic in regards to this, again, is the cash method. So the benefits of that is kind of like I'd already said. It's simpler, it's easier. You have to pick up the income whenever you receive it. So if you're at the end of the year and maybe you've had a really good year and you don't want to have to pick up a whole bunch of like your December, billings and whatnot, then maybe you just send your invoices out later in the year. So as long as you haven't actually received the money, then you don't have to pick it up. Now, if you receive a check on December 31st, technically you've received that even if you haven't put it in the bank. So, but other than that, there's leeway. And then the same thing with expenses. You can deduct them whenever you pay them. So there's a cool rule that the IRS has given us called the 12-month rule. And in that, you can prepay expenses. Say you want to prepay all of your insurance for the next year in December. Well, even though you haven't actually really used any of that, you can still deduct that because it's going to happen in the next 12 months. So that's really, 2 of the big benefits being able to use the cash method over the accrual method. Okay. So the other topic is inventory. So if you're also underneath this $25 million threshold, then you're not required to report inventory and cost of goods sold. So you can report them as non-incidental materials and supplies, or you have to follow the way that your financial statements are set up. So a lot of our clients that we do the bookkeeping for, we still do report inventory and cost of goods sold just because, you know, that is the proper way to do it. And if they have a material amount, then that is better for the financial statements. But technically, if you are under the $25 million threshold, then you have the ability to not have to report the inventory, which would be a little easier. But again, most of the time, we do still report that. So then there's the UNICAP, which I'm definitely not going to get into because it's super complex, and it's very time consuming, and it basically has to do with companies that are producing like personal property or real property. If you are under this threshold, you don't have to mess with it. But if you are over this threshold, you're actually required to add back some of the direct and indirect labor and operating costs that were put into making these products, and you can't expense them until that inventory is sold. So you're losing out on the expenses for that. But not many of our clients have that, and that's about all I'm going to say on that one because it's super complex. But this last bullet on this slide, if you are in, you know, a cash or accrual accounting method right now and you want to change it, we do have the ability to do that. There's a form 3115 that we can fill out for you, and then the IRS will it'll automatically be approved. So that is something we'll be looking at, you know, when we're looking at everyone's tax returns going forward, if they were over the threshold and now are under, and vice versa. Okay, so like I've said before, if you are over the $25 million threshold, you are required to follow the accrual method as well as the several other topics we've discussed. If you were under that, you can use cash or accrual. It's completely up to you. So, I mean, we might have some clients that do follow the accrual method just because it benefits them in a different way. So you also have the ability that if you switch to a different method or whatnot, you can switch back. So the rules to do that is you obviously have to meet the $25 million threshold test, so the previous 3 years. And then you can't have changed your method from cash to accrual within the past 5 years, and it can't be your final year of business. But sometimes this might happen to a company that has a really good year, and then it, you know, increases their 3-year average to be over the 25, and then that way, if, you know, that was kind of an anomaly, then we can get you back into the cash method, but it has to be, you know, after 5 years and meet those qualifications. Okay, so now one of the more relevant topics for a lot of our clients is about depreciation. So the IRS in this Tax Cuts and Jobs Act put a lot of good things for small business owners to be able to use now in regards to depreciation. So the two biggest topics I'm going to discuss is Section 179 depreciation and bonus depreciation. So these methods are in addition to the regular depreciation you get to take. So if you buy a certain piece of equipment, that equipment, per the IRS, has a certain asset class life, so you have to depreciate it over a certain amount of time. So you don't get to take it all up front. You have to take it, you know, per the IRS's rules and per the depreciation method you pick over a certain amount of time. Well, 179 and bonus depreciation help you be able to take a lot faster. So with 179, this is also nice because you can pick and choose how much 179 expense you want to take in that year that you purchase the asset. So you can take half of it, you can take all of it, you can take, you know, whatever amount you pick. So the other nice thing about 179 in the Tax Cuts and Jobs Act is this is kind of like Ryan was saying, a lot of these have like sunset provisions. This is not. It is a somewhat permanent type of change. So with 179, there's a limit on the amount of Section 179 depreciation, which, like I said, is on top of your regular depreciation. And the limit is now moved to $1 million. In the past, it was only $510,000, so they basically doubled it. So if, you know, you're a bigger company buying a lot of equipment or placing a lot of assets in service in a year, this is really beneficial. The same thing with the phase-out limit. So with 179, if you place, starting now, and as of 12/31/17, more than $2.5 million of assets in the year, then you start to get phased out dollar for dollar after the $2.5 million. In the past, this was a little over $2 million, so again, they've kind of bumped that up. which is helpful if you're starting a big company that year and you've placed a ton of stuff in service. Then you might phase yourself out under the old rules, where now it's going to be a little more difficult to do that because they've given you a wider range. And these amounts will be indexed after 2018, so hopefully they will go up at a decent rate each year, because obviously everything gets more expensive every year, so that is good. And then the $25,000 SUV limit, that's just kind of a side note, that'll also be indexed. And then the other nice thing about 179 is if we have to amend your return for some reason, like say new facts come in light or something's changed and whatnot, we can actually go back, and when we amend your return, we can take more 179 or less depending on how your return may have changed. So that is another really beneficial part that the other type I'm going to talk about, bonus, doesn't have all that leeway. So that's another thing that kind of makes 179 great. Okay, so the other big change to 179 is the property that now qualifies. So in the past, the tangible personal property used in lodging facilities, such as like beds and like furniture in the house, kitchen appliances, all that kind of stuff, was specifically excluded. So if you owned a lot of rental homes and you were remodeling the inside of them, in the past you just had to depreciate them over the life of that asset. You couldn't take a whole bunch up front. If, say that year you're going to have a lot of income and you knew it, and you try to do all this remodel, and then you find out, oh, I can't take all this year. That wasn't really very beneficial. Well, now you do have the ability to do that. So that was great. And then the second section right here is about the non-residential improvements or additions. So that does not include rental houses. That would be non-residential, so like the building that your business is located in and such. So now roofs, HVACs, and these different types of systems, you can take 179 on them. In the past, these were 39-year life assets that you couldn't do that on. So you would have to take the cost of that HVAC you just replaced and take the expense over 39 years, which is an extremely long amount of time. So now you do have the ability to take all of that in the first year if you so wish. And then the qualified improvement property, Ryan's going to talk about that a little bit later. So 179, like I discussed, all assets the IRS has determined they have a specific class life, which is basically the amount of time the IRS that says that this asset is going to be good for. So most of the assets, well, all of the assets in the 3, 5, 7, and 10 qualify for 179, and now some in the 15 and 39 life qualify as well, which is great because that gives us a little bit more flexibility and a little bit wider range of assets to do qualify for this. And 179 is eligible on new or used purchased property, so it can't be something that you've been inherited or purchased from a related party. You actually have to have purchased it. Okay, so the non-qualifiers, like I kind of just said, that would be foreign property, property received by gift or inheritance, the long life property, which is the 15 to 39 year, except for the ones that we kind of mentioned, like the roofs and HVAC system and stuff like that, energy and lease property, property used by tax exempts. The one biggest downfall, though, with Section 179 that we come into in a lot of our clients is when you take this extra amount of depreciation, you can't take more than the amount of income you have in that year. So say your business has $50,000 of income before you take any special depreciation. Well, you're eligible to take up to $1 million of 179. If you take over that $50,000 of the income of the business, then it gets carried forward. It can't create your business to have a loss. So that is kind of one of the downfalls, which we'll discuss later. Bonus can make you into a loss, but 179 can't. So sometimes 179, even though you can pick and choose the amount and there's more flexibility with it, we might not want that if we're trying to make this business be into a loss because you have other businesses with income. Okay, so now we'll start talking about bonus depreciation. And it's the other type of special depreciation election you can make. So this change actually occurred as of 9/27/17, which was super helpful because we were able to use it on a lot of our clients' 17 tax returns because it actually came into effect before 18. So we've had a lot of people that we've already been able to give them the benefit of these new rules, which has been great. So the biggest change to bonus was, in the past, it was only on, it could only be on new property that you've purchased. So if you bought a used tractor or a used vehicle or anything like that, you weren't eligible to take bonus depreciation. And a lot of times in like a farm or something, you're not always buying a new piece of equipment every time. So then those pieces of property weren't eligible. Well, they've now decided that you can take that on used property, which is great. The other biggest change is in the past, the way bonus worked is you would get to take your regular depreciation and then you would be able to deduct 50% of the cost of that asset in year one. So they've now changed that to be 100%. So you can take all of that asset in year one. The biggest issue you have with bonus, though, is that it is, like the last bullet point, it's mandatory. You have to elect out of this. So unless you tell the IRS with an election statement attached to your return that you're not doing bonus, they're going to assume you're doing it. And you don't always need all that depreciation. But the election is made on an asset class life basis. So all of your assets in, say, for instance, the 5-year class life, you either elect it on all of them or you elect out of it on all of them. Same thing with all the different classes. So it's if you purchase a tractor and then you purchase another piece of farm equipment, you can't do it on one or the other. It has to be both. So that is one of the other tricky things. Where 179, you can pick and choose assets and you can pick and choose amounts. Bonus, it's asset class life basis and it's all or nothing. And then the other bullet, there is the ability on luxury autos to take $8,000 of bonus. So, and then this slide is basically just showing kind of the phase outs, which again, we don't know if these are going to happen, but technically these are what the rules are now. So we have this new rule up into through, I guess, 2022, and then it starts to fade down. But you can see it's all the way until 2025 before it goes back down to below 50%, which is where we were currently at before this. So it's a long time away from now, and who knows what's going to happen. So we'll just kind of see. And then the other thing about bonus is it encompasses a wider range of asset classes. So this one includes all 15-year life assets, which a lot of times are like leasehold improvements. And then the 20-year class life, which is some farm buildings are in that. Those all qualify too. So there is a little bit wider range of assets that do qualify. And then the other biggest thing on bonus depreciation is there are no maximums, there's no phase outs, and there's no income limits. So if you put in $5 million of assets this year, then you're fine. Like you don't have to, it's not phased out, it's not going to be reduced, anything like that. And then kind of like I discussed too, there's no income test. So a lot of times if we have a client who maybe say you have 3 businesses and they all produce you a K-1 to report on your tax return, and all 3 of them are doing pretty good. Well, maybe you bought $500,000 of assets this year, and the other businesses maybe you didn't. So you want to take a loss on this entity to help offset the other 2 entities. We can do that with bonus depreciation. So we can take all that depreciation in year 1 to help offset the income in the other entities. So that is one of the biggest benefits of bonus depreciation, and why a lot of times we might choose it over taking 179 on different assets. So, okay, then we have the luxury vehicles. I'll just kind of briefly talk about this, but basically in the past, a luxury vehicle would be like just a car you're using in your business, and the IRS wanted to make sure that you weren't buying like this fancy souped up car and driving it around, and you're going to take the depreciation on it as a business expense. So in the past, they really limited the amount of depreciation you could take in a year, which was a lot of times a lot less than what the normal allocated amount would be for that vehicle. So the IRS has now, as you can see, really increased the amounts you can take every year. So now it would really affect actual luxury vehicles instead of like, a Chevy Cruze or something that in the past was even being limited. Okay, and then the last topic I'll talk about is the farm property. So in the past, farm equipment was a 7-year life asset, which means you had to take the cost of that asset and you would have to depreciate it over the 7-year time frame, unless for some reason you took bonus or 179 or whatnot on it. So they've now shortened farm equipment down to 5 years, so that really is giving you a shorter time frame, so you're getting to take more depreciation every year, which is helpful. And then the other thing is that farm assets in the past too were depreciated on what was called 150% makers, which meant, I guess the easiest way to say it is, now you can do 200% makers, which is also just faster depreciation. So both of those we're just trying to help farms be able to take more depreciation in a shorter amount of time so you get more each year. But I think that's all I had to say, so now I will pass it back over to Ryan.
Excellent. Thank you, Amber. I did want to reinforce too on that last slide that the farm asset to qualify for the 5-year versus 7 has to be new, has to be a new piece of equipment. So I think you mentioned that, but I just wanted to emphasize it has to be brand new. So so kind of continue along the lines of some of the depreciation stuff. There are some new categories of depreciable assets now in place. So under the old law, before the Tax Cuts and Jobs Act, there was a couple different categories of improvements to property that you could depreciate over a little bit faster amount of time. That was called the Qualified Leasehold Improvement Property, Retail Improvement Property, and Restaurant Improvement Property. They've basically taken those three now and combined those into one category called Qualified Improvement Property. And so this property is property that's non-residential in nature, so you can't use it on any residential property. It has to be placed in service after the building was placed in service, so it cannot be part of new construction. And the interior improvements cannot be enlargements to the building, they can't affect the structural framework, and they cannot be for elevators or escalators. And so for these new qualified improvement property items, instead of depreciating some of those over 39 years under old law, they can now be depreciated over 15 years, which is a substantial improvement in depreciation write-offs. They're also eligible for bonus depreciation that Amber just talked about, and they're also eligible for Section 179, which Amber talked about. So as you can see, this is a very lucrative piece of the new tax law, and so anyone making improvements to their physical properties, non-residential physical properties, will see some big tax savings. So now we'll move on to the some of the corporate tax rates. So one of the biggest, most publicized pieces of the new tax legislation was the corporate tax rates. All the politicians were really pushing this new 21% corporate tax rate. You can see that in the prior years, there were seven different corporate tax rates ranging from 15% all the way up to 35%. And the new tax law applies a flat 21%. And this is for C corporations. There's a couple different types of corporations. This is C corporations. So, but it's important to note, and I'll mention this again later too, is that many of our clients and small business clients in general, we're not paying as high as 21% anyway. So with proper tax planning, we've kept most of our C corporation clients at the 15% corporate tax rate anyway. So for a lot of these small businesses, they actually are going to see a tax increase of close to 30% because they're going to go from 15% to 21%. So although it's touted as a good thing and it will be good for some C corporations, it's not going to be good for a lot of the small businesses out there. Okay. So this new 21% tax rate applies to all C corporations. There's a few flavors of C corporations out there, including personal service corporations. I don't think any of you in this room are personal service corporations, so I won't spend a whole lot of detail on that. With the new 21% tax rate too, and some of the other things we're going to talk about a little bit, it's a good time to assess whether a C corporation is a good choice of entity for you or whether another form of tax structure is optimal. So we're still waiting on a lot of clarification regarding these new laws. So they passed these laws. There wasn't much talk about them before they were passed. They just appeared, and here we are, a few months later, and we're still waiting on clarification on how to apply some of these new provisions in the laws. So we have met with some of our clients and performed some, basically some entity structure analysis to see if a C corporation or a partnership or an S corporation is an optimal form of structure for them. So keep that in mind that we are able to help run those analyses for you, but some of those analyses are preliminary until we get some of the clarification about these new laws. So as far as C corporations are concerned, well, what are some of the advantages of them? Well, C corporations, they're really the best vehicle for writing off employee benefits or fringe benefits. So if a C corporation has maybe the owner and maybe another employer or two, that owner is able to write off their health insurance, out-of-pocket medical costs. They can write off vehicle expenses. So it's a really great tool for employee benefit deductions. As we noticed a little bit ago, the tax rates are pretty low for C corporations. Although for a lot of our corporations around here, it's actually going to be a tax increase. And C corporations can pay dividends to their shareholders, and those dividends are taxed at what we call the capital gains rates. Capital gains are typically taxed at lower rates than ordinary tax rates. So the shareholders get to benefit from those lower capital gains rates. What are some of the disadvantages of C corporations? Well, there's a couple of big ones. One of them is double taxation. So C corporations are subject to double tax, meaning the corporation pays its own tax at the entity level, and that money has to get paid out to the shareholders either via dividend or salary, most commonly, and then the owner pays tax on the dividends or salary. So although the corporate tax rates have diminished a little bit and decreased, there's still some disadvantages to being a C corporation. And then the other disadvantage of a C corporation, and we'll talk about this a little bit more ahead, is there's no 20% flow-through deduction, which is a new deduction put in place by the law. And so that could have a dramatic effect on a business as well. Corporations, they can be formed a couple different ways. Whenever you form your business originally with the appropriate Secretary of State, you can file to be a C corporation. There's also some other hybrid type entities, such as a limited liability company, that can elect to be taxed as a C corporation. So there's a couple of different ways to become a C corp, and that's why we're doing some of these analysis too, because we have several clients who are LLCs, limited liability companies, and our analysis kind of helps determine, what's the maximum cash back in the pockets of those owners, and should there be a C corp or should there be another type of business entity. So we can change types of entities around, which is good. So now we'll move on to one of the other provisions that is going to affect several of you in the room too, especially farmers. I know we have some construction companies in here too. So this is in relation to like-kind exchanges. So effective for any exchanges of property after 12/31/2017, tax-free like-kind exchanges only apply to real property, not equipment. So what does this mean to you? As Amber talked about a while ago, let's say you have a combine and you trade in your combine for a new combine. Well, under the old like-kind exchange rules, you had equipment. You could trade those in one for the other one, and whatever the cash difference is that you pay on the trade is essentially your new basis that you can depreciate and look at maybe some of the new depreciation elections. So you could swap those out and just deduct the difference of the cash trade. So under the new law, since you cannot like-kind exchange property equipment, whenever you trade that combine in, whatever the trade-in value of that combine is, you report that as income in your tax return, separately from any depreciation related to the cost of the new combine. So if you buy a combine or do a trade-in on a combine that's a $200,000 combine, they give it a $100,000 trade-in value on your old combine, the $100,000 is going to be income now. And then the $200,000 that you're paying for the new combine, you'll make your own independent depreciation elections with that new purchase. So that's going to be a dramatic change in the way things have been reported in the past, and it could get some people into a little bit of a pickle, unintended pickle a time or two. So okay. One of the other biggest changes that are really rubbing people the wrong way, and I think this was a piece of the new tax law that most people didn't pay attention to early on, it has to do with entertainment deduction. So you go to Royals game, Chiefs games, or any sporting event, and you'll see, some of the larger corporations, they have a suite or a box or something along those lines. Well, those entertainment expenses used to be 50% deductible for tax purposes. But under the new law, those are no longer deductible. So these corporations will not get a deduction for paying for tickets to athletic events, buying the suites, things like that. So that could have a little bit of a trickle down effect. I don't know, ticket sales maybe offer some of these events as a result. It's hard to tell what the consequences are going to be, but so we haven't seen a whole lot of publicity about that, but I think it's going to be kind of an aha moment for several of these businesses. Meal deductions, that's another piece of the tax law that changed. So related to the entertainment in those skyboxes and suites, whatever else, not only was the rental of that suite deductible up to 50%, but the meals associated with that was deductible up to 50%. And now those meals are no longer deductible unless the meals are related to work travel. So if you're traveling for work as opposed to entertaining a client, you can still get the 50% deduction for those meals. So we put this slide in here. I'm not sure that it applies to many people in here. There's some code sections that allow for some fringe benefits to your employees for commuting and transit passes, bicycles, things like that. But I won't spend much time on that. I just wanted to point that out that there were some changes there. So then we'll move to this Section 199 DPAD, which stands for Domestic Production Activity Deduction. Some people just know it as production deduction. So there used to be this Section 199 DPAD deduction in place. A lot of the farmers in the room are very familiar with that. Some construction companies as well are familiar with that. That has been completely repealed. So that was some businesses, that was a very lucrative deduction, and it is gone. It's been replaced with something else we'll talk about here in a little bit. Something else that changed, some other odds and ends that changed, are employee achievement awards. They may no longer include cash, gift cards, coupons or certificates, vacations, tickets to events, things like that. So that may rub some people the wrong way too, but it's not going to affect as many people as some of these other things we're talking about. Sticking with the odds and ends, most of our clients have fewer than 50 employees, so they're exempt from the Family Medical Leave Act. But we put this slide in here too, just to make you aware of a couple changes to that. The next slide actually talks about employers with fewer than 50 employees can elect to honor the Family Medical Leave Act, and this new law put in a tax credit. So if you have someone that is out on maternity leave and you want to continue to pay them, there's a new tax credit in place that will help subsidize the wages to those people. So I think this is a very positive thing within the new tax law. Okay. Interest deductions. This is going to be a big change for many businesses on a larger scale. So the larger businesses are going to be impacted. Many of the small businesses in America, which most businesses in America are small businesses, are not going to be impacted as much by this. But so interest deductions now are going to be limited for businesses with gross receipts of greater than $25 million. It doesn't matter if you're a C corporation, S corporation, partnership, proprietorship. It doesn't matter if your gross receipts are greater than $25 million. The amount of interest expense you can deduct will now be limited. So, and then you may be asking, well, what happens to that non-deductible interest? Well, it's carried forward indefinitely. So hopefully, at some point down the road, you'll be able to use it. So the other most highly talked about aspect of this Tax Cuts and Jobs Act was this business pass-through deduction. This impacts almost every business that we touch. So we want to spend quite a bit of time on this piece of it. So what is this pass-through business deduction? Well, it's a deduction allowed for 20% of qualified business income from pass-through entities, and it happens at the individual level. So if you have an LLC, it's taxed as a partnership. This deduction is actually going to be computed on your personal tax return, not on the partnership tax return. But you'll notice in quotes on that top line that it says qualified business income. We're still waiting on some clarification as to what that actually includes. We have a pretty good idea what it's going to be, but we don't know for sure. We don't know if rental income is going to qualify as qualified business income or not, and so makes planning in some cases a little bit difficult, but we'll keep you guys apprised as we find out more stuff. So as I mentioned earlier, we'll post stuff to our social media, Facebook, LinkedIn, probably put something on our YouTube channel. So we encourage you to follow us to stay up to date on this information. So this pass-through business income deduction applies to all profitable businesses, except for C corporations. You know, we talked a little bit a while ago about C corporations getting the lower 21% tax rate. They don't get this new 20% deduction because they got a lower tax rate. So, so all profitable businesses will get a 20% deduction equal to their profit if the owners have taxable income of less than $315,000 married, or $157,500 for single taxpayers. So, and if your profit ends up being over that $315,000 or over the $157,500, there's some other limitations that are going to apply, and we'll talk about those here in just a minute. So let's look at an example of this. Let's say Harvey has a small business, and his small business made $100,000 of net income, but he also has some other things on his tax return that reduced his total income, so that his taxable income on his tax return is actually on $88,000. So when we apply this new 20% deduction, we take the lesser of 20% of his business income, so it'd be 20% of his $100,000, or we take 20% of taxable income after deductions, which would be 20% of $88,000. So in this deduction, in this example, Harvey's going to get a new deduction of $17,600. So that is definitely a highlight of this new tax law. It's going to benefit many, many small businesses. So I guess you can think about this qualified business income deduction almost as an additional itemized deduction. For those of you itemized deductions, this is kind of like an additional one of those. It's going to reduce your income quite a bit. So how does this apply to high income taxpayers? Well, as I mentioned a while ago, if you're above those thresholds, whether you're married or single, there's a wage and capital limitation and a specified service, trade, or business limitation that apply. And these could sneak up on some unsuspecting taxpayers, so it's good to be aware of these. It's important to note that neither of these limitations applies if taxable income is below these thresholds. So if your income is below $315,000 for married couples or $157,500 for a single filer, these do not apply. So things will be simplified for you a little bit. Okay? So both these limitations begin once a taxpayer's taxable income. It's important that we emphasize it's your taxable income, not your adjusted gross income. So this is actually to the taxpayer's benefit, because your taxable income is typically, it's always going to be below your adjusted gross income, because your taxable income takes into effect your standard deduction or itemized deductions, things like that. So, so this is a good piece of the tax law. So like I said, this limitation begins at $315,000 for married filing joint filers, and $157,500 for all other filers. So both of these limitations, the 315 and 157.5, they're fully phased in once a taxpayer's taxable income reaches $415,000 for married people and $207,500 for all other filers, meaning that between $315,000 and $415,000, there's some proration of this deduction, and then after that, there's some other rules that apply that we'll also talk about here in a little bit too. So what's this wage and capital limitation that we talked about? Well, this wage and capital limitation is the greater of 50% of wages paid in your trade or business, or the sum of 25% of wages paid in your qualified trade or business, plus 2.5% of unadjusted basis in qualified property. So what that last bullet point means is everybody has assets on their depreciation schedule. You have land, you have equipment, computers, whatnot. So whatever the cost of those assets are in your depreciation schedule times 2.5% is how that's computed. So it does not subtract out depreciation you've already taken on those assets, which is an important note for this limitation. And there's also some other details about how old the property is whenever you include it in this computation. But we'll handle the details. Just come talk to us. We'll help you out. Okay. So what's the definition of wages? Well, wages are they're defined as wages paid in respect to qualified trade or business. So it's basically anything that's paid to an employee that's subject to withholding, plus elective deferrals into a retirement plan of some type. So it's essentially box 5 of a W-2. So for those of you who prepare W-2s, it's essentially box 5. And I do want to note too that wages do include wages paid to related parties. So that could be a key factor. So we talked about specified service businesses a little bit ago, and there's some limitations for these certain types of businesses. So taxpayers in specified service businesses whose taxable income is below the minimum threshold, which we mentioned a while ago, those dollar amounts, they get to claim the full Section 1998 deduction. So they have no limitations. They don't have to apply the wage and capital limitation. They just get the whole thing. So if their income is above the thresholds, meaning $415,000 for married people, $207,500 for all others, if you're in certain trades or businesses, which we'll define in a minute, you get none of this. So it's an all or none deal for these people. And if you're in between those phase-out ranges, you may get a portion of it. So what are these specified trade or businesses? Well, it's people in the health care field, law, consulting, unfortunately accounting, which includes us, performing arts, financial services, brokerage. So we have a different set of rules that apply based on this 20% deduction than people outside of these businesses. And it's also important to note that the definition does specifically exclude, and I'm not sure why, but architects and engineers. So who knows? Go figure. All right. So one of the most important things with these new laws is choosing which type of entity is the best choice for you to operate in. So we talked about the lower 21% corporate tax rate, which we talked about could be a tax increase for some of our C corporations. So whenever we do this analysis, we may advise that your C corporation become an S corporation for various reasons too, so you can benefit from this 20% pass-through deduction. So choosing your entity is important. What kind of dividends are you going to have? What kind of tax rates are they going to be taxed at? Okay. So what are some of the baseline planning considerations when you choose what type of entity you want to be? With respect to this 20% qualified business income deduction? Well, I won't get into the details of it, but there's some bend points in Social Security where if your earnings history hits a certain threshold, you get this bump up. So they call it a bend point because when you graph it out, it's actually a bend in the graph. So we want to look at the Social Security bend points. We want to look at capital gains rates because if you are in certain tax brackets as an individual, you may pay 0% tax at the federal tax level on capital gains. So we want to make sure you take advantage of that. We want to see how that 20% pass-through deduction is going to impact you. And by the time you run the analysis mathematically, if you're in the 25% tax bracket and you qualify for this 20% pass-through deduction, you're actually paying tax at 20% tax rate instead of 25. So there's some play with tax rates that we can help you to work through. We also want to consider too in the choice of entity is fringe benefits. We talked about C corporations being the best vehicle for deducting fringe benefits. And so that's a major concern. And then something that hasn't changed is S corporations have always had to pay a reasonable compensation to their owners. And so, and then all the other income from the S corporation is exempt from self-employment tax. So just an example, let's say you have an S corporation that makes $200,000 a year. The owner takes $100,000 in salary. They pay self-employment tax on the $100,000 of salary that they paid themselves. but the other $100,000 of profit that they take out is not subject to self-employment tax. So you save that self-employment tax, and that's why S corporations have been so valuable. But with the new tax laws, you basically have to run the numbers to see if that's still to your best benefit or not. So, and then a few other or some of the information that would need to be gathered to run analysis to compare choice of entity selection as related to this new tax law. Obviously we want to look at the entity's profit, not just historical profit, current year profit. We want to know what your plans are going forward. If you're a corporation and you plan on retaining the profits within the corporation to grow and expand, well, that may lead us down the road of one entity type over another. We also want to know, what the health insurance plans look like within the entity, subject to entity fringes. We want to know what type of distributions come out of the corporation, whether we want those to be taxable dividends or salary or whatnot. So there's several different things we want to look at as we do this analysis. I also wanted to put a plug in too that in light of all of this development within the new tax law, like I said, we're still waiting for some clarification. But we've already performed some business entity analysis for several clients to help choose, or help solidify whether their current choice of entity is optimal or not from a tax and overall wealth perspective. Because the ultimate goal always is to maximize the cash to the owner. And so as you can see, there's a lot of nuances that impact that. And so we've put some tools in place and create some processes to help owners assess their current tax situation and see which choice of entity provides them the most cash after taxes. And then we're also getting ready to roll out some kind of a pared down level of that entity choice analysis. And it's going to be more for individuals, maybe some W-2 wage earners that have maybe a small business on the side, or just some small businesses in general that have a little bit lower level of revenue. So we're kind of living in a golden age in many ways from a tax perspective. So this may be one of the greatest times to save taxes and help increase your overall wealth and generate wealth. So we just want to encourage you not to take that lightly and seek out some professional advice, because the last thing we want is for someone to get caught off guard and miss out on some of the opportunities, because we don't know how long these opportunities are going to be around. Next administration may come in and change those. We really don't know. So. So yeah, give us a call. We're glad to help you, and if we can't help you, we'll direct you in a direction that we can get you some help one way or another. So I just want to thank you for coming. Make sure you take those folders with you. Reference those slides. We'll stick around for some questions afterward. We'll even answer some questions live here if any of you have any. I did want to point out that there should be a short evaluation form in your packet. We try to keep it really short because we go to lots of seminars and we get tired of filling out long evaluation forms. So if you just give us a little bit of feedback, we'd really appreciate it. Like I said, this is our first seminar, so we're still learning as we're going as well. So any feedback, constructive feedback is appreciated. And so I'll open it up real quick here to see if anyone has any questions they want to ask in front of the group. And like I said, if you don't want to, then we'll be around afterwards to answer those individually. Anybody have any questions? Okay, well, good. Well, we thank you for coming. Like I said, I want to thank Kelsey, Amber, Brandy, the FBLA students for helping us out, and all of you for attending. We're very happy with our attendance for our first seminar, and based upon the turnout, we'll likely do some more of these with some other topics. We'll probably do one focused on individual tax issues, and then we might also do one for farmers as well. So, because there's so much complexity in this new law that we want to get the word out and make sure no one misses a year of opportunity. So, thank you again for coming, and we'll see you next time.